Amazon just got hit hard. Right after earnings, the stock dropped around 15%, and instantly the headlines started flying. AI spending is out of control. CapEx is exploding. Margins are in danger. But here's the reality. This sell-off wasn't because Amazon's business is breaking. It wasn't because AWS demand is collapsing. And it definitely wasn't because Amazon suddenly became a weak company. The drop happened for one main reason. Wall Street panicked over CapEx. Amazon announced it plans to spend around $200 billion on capital expenditures, mostly tied to AWS and AI infrastructure. And yes, that number sounds crazy, but the market is treating it like Amazon is wasting money, when in reality, Amazon is doing what it has always done best, spending early to dominate later. Here's the part most investors are ignoring. AWS isn't slowing down because demand is weak. AWS is slowing down because demand is too strong. Amazon's cloud backlog is now around $244 billion, up roughly 40% year over year. That is not the number you see when customers are leaving. That's the number you see when customers are lining up faster than you can deliver. So AWS isn't losing momentum. It's supply constrained. And if your biggest problem is we can't build fast enough, then spending money isn't reckless. It's necessary, because if Amazon doesn't expand cloud capacity now, competitors will happily take those customers. And in cloud, losing customers isn't like losing retail shoppers. Once a business builds its systems on Microsoft or Google, switching back later is painful and expensive. So this CapEx plan isn't a gamble. It's defensive. It's Amazon saying, we're not letting anyone take the AI cloud market from us. CEO Andy Jassy basically confirmed this on the earnings call. He said customers want AWS for both core workloads and AI workloads, and Amazon is monetizing capacity as fast as it can install it. That last part matters, because Amazon isn't spending based on hype. They're spending because demand is already sitting there waiting, and if you've followed Amazon for years, you've seen this movie before. Back in 2020, Amazon spent aggressively expanding its logistics network. Investors complained about free cash flow and margins back then too. But a few years later, that spending turned into one of the biggest competitive advantages in retail history. Now Amazon is doing the same thing again, except this time it's not warehouses and delivery vans. It's data centers, GPUs, and AI compute. Basically the logistics network of the AI economy. Yes, free cash flow will look ugly in the short term. That's unavoidable when you're building infrastructure at this scale. But here's what makes Amazon different. Amazon isn't just retail anymore. It has multiple profit engines that keep getting bigger. AWS advertising, third-party seller services, Prime subscriptions, and these segments are far more profitable than traditional retail. So while investors are focused on CapEx pain, they're ignoring what this spending is really doing. It's protecting Amazon's strongest businesses and setting up the next growth cycle. Valuation-wise, the market is already acting extremely pessimistic. Even with conservative assumptions, slower growth, pressured margins, heavy spending, Amazon still looks close to fairly valued. But if AWS keeps growing at strong double-digit rates, advertising keeps scaling, and third-party keeps expanding, the upside becomes huge and expands to around 120%. That's the market pricing Amazon like it's in trouble, while the fundamentals suggest it's preparing for another decade of dominance. Of course there are risks. Execution risk is real when you spend $200 billion. Power is a real issue for data centers, and regulation is always hanging over Amazon. But even with those risks, this 15% drop looks more like short-term fear than long-term damage, because the market is punishing Amazon for doing exactly what it should be doing, investing in the future. And historically, when Amazon goes into build mode, that's when the biggest long-term opportunities get created. So this sell-off doesn't look like a warning sign, it looks like a discount.